Hi, everyone. Thank you so much for joining Carta's webinar today. My name is Dana, and I focus on working with private equity firms here at Carta to make sure that the PE firms and the portfolio companies are getting the most out of Carta. I'll first share an outline of today's topics, as well as introduce our speakers and our panelists. So today, we will be touching upon 5 different topics. First, value creation, which is the cornerstone of private equity success to maximize returns. 2 is human capital and talent management as the most leveraged pillar to value creation. 3 is about how employee ownership is used as strategy in talent management. 4, why so many different private equity firms are committing to expanding employee ownership. And finally, we'll take a look at how employee ownership is actually tracking in PE by diving into data from Carta's recently released annual PE ownership report. And so now let's introduce our guest speaker, Shiv, and our panel. And so first, Shiv, hi. Can you tell us about yourself, about your podcast? Why did you start it? Who have you interviewed and how it's been?
Yeah, thanks for having me. My name is Shiv Narayanan. I run a firm called How to SaaS, and we work primarily with private equity investors and their portfolio companies, especially as they make new investments and are building value creation plans on the marketing side. And so I've been doing this for about 5 years, and we work with some of the leading private equity investors out there like TA, HG, just to name a couple. And we work with software companies, B2B companies that are as small as 5 million and upwards of 200 million and 500 million in revenue, some even public. And then I started the podcast mainly because of our unique private equity relationships. Just in the PE space, there aren't enough content platforms out there to talk about value creation drivers as much. And so we decided to build it ourselves and bring on some of the most notable guests and thought leaders in the space to educate the market more on how to drive enterprise value for portfolio companies. So excited to be here and talk about the talent side and how employee ownership can impact value creation as well.
That's awesome. And thank you so much. And second, Hamza, can you tell us about yourself?
Sure. Thanks for having me. Hi, everyone. My name's Hamza. I'm an insights manager here at Carta, and I work to uncover and share findings and insights on private markets with the broader ecosystem.
Great. And then lastly, Peter, can you tell us about yourself?
Hey, everyone. My name is Peter. I run the insights team here at Carta. I've been focused traditionally on going through all of the information that Carta knows about venture capital companies, but so excited to get into the private equity space and learn from Shiv and others about how our data can be helpful there. So happy to join.
Thank you so much. All right. Then everyone here, so there is a chat function. So if you have any questions throughout this time, feel free to drop in your question and we'll get going on them. And now let's dive in. So Shiv, I'm going to come back to you. Can you kick off by telling us about value creation? Really, like, what is it?
Yeah, I think it's important to start with understanding what is the business model of private equity. So in general, PE firms raise money from limited partners. This would be endowments, retirement funds, pension plans, things like that. And their mandate is to deploy that capital and generate a return for those LPs. And in a lot of cases, they are competing with a ton of other private equity firms and capital in order to land assets that they can use to grow their assets under management or capital that they're deploying. And there's a crazy stat, which is that there's almost $3 trillion of dry powder out there, which means that that's capital that's uninvested at the moment. And that's competing against each other. And so you have a lot of private equity firms that have emerged in the last decade, and they're competing for a limited set of assets. So in this kind of an environment, value creation is critical to actually driving alpha for those funds. And value creation can be organic or inorganic. And inorganic is just M&A and growing through mergers and acquisitions. And organic is what is available to a particular business within its levers, whether it's marketing and sales, whether it's people, pricing, and all these other growth strategies that are available. And so as PE firms are thinking about growing their respective assets, like one of the biggest conversations that happen inside PE firms is how to drive enterprise value.
That is spot on and consistent with I mean, every private equity website I've seen, they talk about their value creation levers and try to highlight how different they are from each other. And I think honestly, as you dig in and actually talk to these operators at these private equity firms, they are different and they are unique. So it's very important to understand what those are for each firm. And so Shiv, one more question for you. Thinking about your podcast on value creation, right? What trends are you currently seeing? And to you recently, what has stuck out to you the most about value creation?
Yeah, I think when we were working with PE firms a couple of years ago, when interest rates were low and the deal volume out there was high, a lot of PE firms were looking at M&A as a critical growth strategy, and also revenue was easier to come by. And so even though there's something called the rule of 40 that private equity firms across the board really try to judge their companies against, which is a measure of what percentage is your profitability and what percentage are you growing year over year. And then if you add those two numbers together, if it's above 40, you're actually quite a healthy business. And so if we looked at it 2 years ago, it may have been that revenue growth made up a bigger percentage of that number than it does now. And so what's shifted recently is that the focus on profitability has become more important as growth has been harder to come by. And with that comes certain decisions when it comes to value creation, where you look at marketing and sales and every dollar that you spend on it, you want to make sure that your CAC payback period is in check. You want to make sure that operationally you're not over investing in certain areas to generate the margins that you're generating as a business. And the people side of that is super important. One of the things that we're getting plugged into a lot now is making sure that the org structure and org design is set up correctly. Do we have the right number of people in the right seats? Or do we have too many people? Do we have the right skill sets to get us to the next level? And how can we do more with less? And so that conversation has really shifted, I would say, in the last couple of years.
Shiv, can I jump in here? Has there been a meaningful difference in your view about how the market is valuing growth versus profitability or unit economics? Or is it really just because growth is harder, the focus has shifted, but in an ideal world, the market would value them as they would have, 12 or 15 months ago?
I think they're still equally important. I think that the big shift that's come is just valuing profitable growth. I'll give you some examples. Like there's one really large company that we work with, about 500 million in revenue, market leader in their space, and their CAC payback period on some of their campaigns and activities was over 2 years. In some cases, it was 5 years for some of the channels that they were spending on, and that went unnoticed up until last year when we started working with them. And this new PE firm made this acquisition. They split it off from a public company. And immediately the question was, well, how can we make this go to market more efficient? And that meant sacrificing revenue, but we were able to cut $10 million in spend there while only sacrificing about $500,000 in new revenue. And so that's a trade-off that they're willing to make now, where maybe 2-3 years ago, it was less acceptable because it's growth at all costs and capital was easier to come by. And so it's just better to just be more profitable now and save that cash for other activities.
Yeah, that makes total sense. I appreciate that, the color.
Yeah. Well, coming back really quick to this human capital topic that Shiv already alluded to. So now back to human capital. So Shiv, why is human capital such a critical lever for PE value creation today? And what are they actually doing? What are the PE sponsors actually doing to address human capital needs across their portfolio companies?
Yeah, you mentioned something earlier, which is you said that, every PE firm talks about value creation on their websites. And it's funny and also true, but in a way, if you hear private equity firms talk about this, and I see this on the podcast every day when I interview these firms, a lot of them have the same talking points. Everybody wants to improve their gross margins, wants to drive pipeline and revenue, sees pricing as a strategy, looks at M&A as a driver. It's about the same across the board. But at the end of the day, whatever value creation plan you build, is the critical point of failure is if you have the right people. And we can build the best value creation plan possible, but if you don't have the right leader for revenue or sales or marketing or product, your plans are going to fail. So I think that is something that just private equity has clued into, especially I would say in the last 4 or 5 years. Having the right people in the right seats and what it actually takes to succeed has changed. And you're kind of seeing that in terms of how they look at ownership. And we're going to talk about the report and stuff like that as well, because they see that that is the X factor in being able to succeed with their value creation plans.
Yeah, spot on. I would say I'm talking to PE firms every single day, right? And a lot of them, especially more in the recent years, have really leaned into giving equity beyond just management, because traditionally equity is just with management to give them the incentive to really like hit that home run and bringing all the revenue and grow the business. But nowadays, and maybe this is because tech has done such a terrific job of giving equity to everyone, private equity is also getting into that. And so having that said, right, so we're seeing more and more PE firms leaning into employee ownership. Another term that some folks on this call may have come across is this concept of broad-based ownership. And so two things I'll mention is, so the bigger firms, right? So Pete Stavros at KKR, he has been very, very vocal about this. He even founded an organization called Ownership Works, which many of you may have heard, and a bunch of PE firms are part of that. And what they're doing is trying to identify and implement broad-based ownership plans to portfolio companies at private equity firms. Also earlier, what I thought was interesting is earlier this year in May, Blackstone separately came out and made this public announcement about a new program where they will distribute ownership to employees at the portfolio companies in the future buyout acquisitions. And so we're seeing this movement, right, and public announcements by these bigger firms, and we're seeing the smaller PE shops also following.